In 2014, Marcus Webb parked a leased Cadillac outside a rented townhouse in Tulsa. 10 years later, that car was gone, the townhouse was gone, and Marcus stood beside a paid-off truck in front of a home he owned outright. Same income the whole time, same city, same amount of money running through his hands every month. One habit, repeated for 10 years, built that second scene. So tell me, rent or own? Marcus grew up in a house where money came in on Friday and disappeared by Monday. His dad worked at a tire plant for 26 years and never once asked for a raise because more money always found a way out the door before the weekend ended. Marcus swore he'd do better. At 24, he landed a good job selling industrial parts, pulling in $60,000 a year, more than either of his parents had ever made in a single stretch. He felt rich. He started acting like it too. New truck, new watch, a gym membership he barely used, and a phone plan nobody needed. Every dollar that hit his account already had a job waiting for it before he'd even opened the banking app. For 6 years, that felt fine. His paycheck grew a little every year, and his spending grew right alongside it, like the two were tied together with a string. Financial people have a name for this. They call it lifestyle inflation, but you don't need the term to feel it. It's the sense that no matter how much more you make, you never actually get ahead. Marcus wasn't broke. He wasn't in trouble. He just never moved. 10 years in, his net worth sat close to zero, same as the day he started, except now his monthly bills were 3 times higher. Most people assume the fix is simple, earn more, and the gap closes on its own. Marcus believed that too, right up until a promotion landed on his desk with an extra $1,000 a month attached to it. He was thrilled for exactly 9 days. By the 10th day, that extra money had already found 4 new places to live. A bigger apartment, a nicer car payment, dinners out twice a week instead of once. The raise changed his lifestyle. It didn't change his life. Money doesn't build wealth by showing up. It builds wealth by what happens to it in the first 60 seconds after it lands. Marcus didn't work any of this out on his own. It took a Tuesday morning in a parking garage, staring at a check engine light, running numbers in his head that came up $400 short. If you've ever sat in your own car doing that same math, go ahead and hit subscribe now, because the habit that pulled Marcus out of that garage is coming up in a few minutes, and it works no matter what your paycheck looks like. Marcus wasn't the only one on that block chasing the same problem. His neighbor Dale worked a similar job, made almost the same money, and handled every emergency exactly the way Marcus used to, with a credit card and a promise to pay it down later. Dale was a nice guy, the kind who'd help you move a couch on a Saturday. Dale also just turned 52 with $11,000 in his 401k, and a mortgage that wouldn't be paid off until he was 71. Nobody plans for an ending like that. It happens one skipped month at a time until skipping becomes the whole plan. Marcus didn't want Dale's ending, so the week after the parking garage, he made one change, almost too small to matter on paper. But that one change is the reason his driveway looked completely different 10 years later. The change wasn't complicated, and it had nothing to do with willpower, because willpower is the thing that runs out first every single time. Money that lands in your checking account has already lost the fight before it started. The delivery app is one tap away, and your brain treats a text asking for a night out as urgent, but your future self never gets to text back and argue his case. So Marcus stopped letting his future self show up late to that argument. He opened a second account, one he couldn't even see on the main screen of his banking app, and set up an automatic transfer for the day after payday. $100 moving out before he'd touched a cent of it, not after rent, not after groceries, before his life had a chance to claim that money for something else. Rent still got paid. Groceries still showed up in the fridge. But now there was a bill sitting at the very top of his list with his own name on it. And that bill got paid first, automatically, every 2 weeks, whether he remembered to think about it or not. $100 doesn't sound like the kind of habit that separates rich people from poor people. But the math behind that $100 is where the real separation happens. 26 transfers a year comes out to $2,600. Left alone in a simple investment account, earning something close to the market's long-term average, that $2,600 a year grows into almost $38,000 after 10 years. Not because Marcus got lucky. Not because he picked some hot stock a coworker told him about. Because the money moved before he could talk himself out of it. And it kept moving, month after month, without needing his permission twice. Here's the part Marcus didn't expect. Once the habit was running, it got easier to grow, not harder. Every time he got a raise, he split it in half before it ever touched his regular spending. Half went into his life the way raises always had. Half went straight into that transfer, on top of what was already leaving automatically. His income kept climbing the same way it always had. But now his savings climbed with it, instead of getting left behind in the dust every single time. That's really the whole habit, and it's worth saying plainly, because people love to make this sound more complicated than it is. Pay yourself first, automatically, before your bills, Before your comfort, before your brain gets a vote, the amount barely matters when you're starting out. $25 works the same way 100 does, just slower. What matters is the order. Rich and poor in Marcus's case was never about the paycheck. It was about which line item got to move first. Picture two people standing at the exact same ATM on the exact same payday, pulling the exact same amount of money. One of them has already lost $40 to a future they can't see yet. The other one just gained $40 toward a future he's building on purpose. Nothing about that moment looks different from the outside. That's what makes this habit so easy to miss and so easy to ignore. It never announces itself. It just quietly adds up in an account most people forget to check. Marcus checked his, though. 6 years into the habit on an ordinary Sunday, he opened that hidden account out of pure curiosity and sat there for a minute, doing nothing but staring at the number. It wasn't the size of the balance that got him. It was the fact that he hadn't thought about it once in 6 years, and it had grown anyway, without a single ounce of willpower involved. By year 10, that account, combined with a few smart moves along the way, let Marcus put a real down payment on a house instead of renewing another lease. He drove that truck you saw at the start, paid off, no note hanging over it. Dale, meanwhile, was still working the same job at 52, still one bad month away from a credit card doing the talking for him. Same block, same years, two completely different driveways. Marcus tells his son now, whenever the kid brings home his first paycheck from a summer job, it's never about how much you make. It's about which bill you pay first, and whether that bill has your own name on it. His son thought that sounded almost too simple to matter. Marcus just smiled, because he used to think the exact same thing, right up until it quietly built him a different life. You don't need Marcus's paycheck to start this tonight. You need an account your bank app doesn't put front and center, and one transfer set to move the day after you get paid, before anything else touches that money. 10 years from now, somebody's going to be standing in a driveway wondering how the guy next door pulled it off. Set the transfer up before you close this video, and it might as well be yours. Now, if you want to know exactly how much to send to that account without wrecking your monthly budget, that math is coming in the next video, and it's simpler than you'd think.